everyone, welcome back to ASX Market Watch and charting trend signals around the world. This is where we look at the charts of your favorite world indices and determine which way 3 out of 4 stocks might be heading as well. For example, if the index is heading up, like the S&P 500, the All Ordinaries, the FTSE, the Hang Seng, whatever it might be, if that index is heading up, chances are likely that 3 out of 4 stocks are heading up with it. It's a fantastic methodology that you can use to complement your current methodology. Let's jump straight into it because the first one we're looking at is the All Ordinaries, and we've got two of the most important lessons that I really want to share with you. And look, I'm just going to jump straight into those lessons straight up because the first one is look at all the markets around the world. A lot of them, or a lot of the ones, especially in the US and also in Europe as well, they're actually heading up. Now, this is despite their economies are really not doing that well. Like they're actually, there's a lot of debt involved. There's a lot of downgrades and that sort of thing, and yet the markets still go up. Why is this? It's a very simple, and this is one of the lessons, lesson one, that I really want to impress upon you. That is, it doesn't matter about the economics behind a market. The only thing that matters is the flow of money in or out. And basically that is what drives the market. It's supply and demand in its purest form, and if there's more money going in, then chances are the market will be heading up, and that's exactly what's happening at the moment. There's cheap money. Money is being made available to all of these huge institutions to try and get them out of trouble. And what are they doing with it? Well, of course, they want to put it somewhere where it can grow, and so it's going into the markets. So this is what happens. More money in equals basically the market heading up. Less money in or money flowing out equals the market heading down. So throw away your book on economics, just look at the flow of money, and that's where the charts come in very handy. Look, the second thing is, this is the All Ordinaries, guys, really quickly. As you can see, it's below the 150-day moving average and would be below the trend line as well. They're very similar, these two, the 150-day moving average and the trend line. That's why I use them. Very simple stuff, not rocket science in any way, shape or form. As you can see, look, they're pretty much identical. It's just beautiful stuff, absolutely beautiful. Apart from that, as you can see, we've got this uptrend line, downtrend line, and where is the market? The market is heading sideways, exactly right. So what does that mean for stocks? Now look, during times, this is lesson number 2, by the way, and it's very important, and that's why I'm actually very excited to bring it to you. This is back in August. Check this out. So we had our downtrend start in May 2011, and then in August it really just went to town. It had a great time, a lot of shorting, a lot of selling, and and so that's when basically you would not want to be owning stocks during this time because the overall market will drag the stocks down. Okay, so in other words, 3 out of 4 stocks will be following the overall market. The market will be heading down. Not rocket science in any way, shape or form. However, after that time, the market needs to take a little bit of a breather. Now, it takes a bit of a breather, and as you can see, check it out. It goes sideways for almost 6 months. And as you can see, the volatility is getting less and less. Now, when the volatility gets less and less, it means basically that it can't stay that way forever, and so it needs to make a breakout either up or down very shortly, and that's when that breakout does occur. That's when you'll see the volatility increase. And look, to be quite frank, volatility is what you need in the markets to make money, because if the market's going up sharply, that's when there's a lot of money to be made, or if it's going down sharply, that's also when there's a lot of money to be made if you know how to short. So guys, that's a lot to take in, but really brilliant stuff. Like, these 2 lessons are very important. The last part of that lesson is, if it's going sideways, then you can take, there will be stocks in the market that will be going both up and down. So there will be stocks that will be going up, and you might make a 10 to 20% gain on a stock during this time, and there'll also be stocks that will be heading down or still down from this downward market here, and you might make a 10 to 20% gain on the downside during this time as well. So in other words, because there's no direction in the market, then it doesn't influence your individual stocks. Now, whereas a time like this back here, because it's severely down and it's really direction, there's a really solid direction to the market, because it's heading down, that will influence the direction of your individual stocks, and even good stocks during this time can fall. So just to like take a little second to like absorb that, because it's that, seriously, that is, it can be one of the most part of the most powerful information about the stock market, I believe, that if you truly grasp what those two things mean, the flow of money and then up, down, and sideways markets, what that means for your individual stocks, then that can truly have a great impact on your individual trading and investing. Guys, really quickly, the indices, this is a sideways market. Obviously, it needs a breakout up or down. And again, really quickly, the S&P 500, we called an uptrend last week. That's exactly what's happened. It's above its 150-day moving average. It's still in an uptrend. Why is that? Obviously because of the flow of money. Exactly. What we've got is there's resistance, and it's basically flirting right with the trend line resistance. So if it breaks above this level, then that's going to be even better news for the S&P 500 in America. Really quickly, the FTSE, again, we called a short-term uptrend on the FTSE. There you go. It's above the 150-day moving average, which is the green line there, and the downtrend line, and it's still just flirting with that level. It is still in that uptrend, which is good. And what have we got? So there's still heavy resistance at 6,000 on the FTSE. It's got a lot of hurdles to get over, but it is definitely in a short-term uptrend for now. Really quickly is the Hang Seng in Hong Kong. Now that's still below its 150-day moving average, and you'll find that it's still below the trend line as well. So 20,000 is the level to beat on the Hang Seng in Hong Kong, in China, around Asia, basically. So if it does get above around about 20,200, 270, then that would be basically a very good sign for Hong Kong. Until then, it still does remain in that sideways sort of movement for now. And last but not least, the Nikkei still remains in its downtrend, still well below the 150-day moving average, and there's not even a downtrend line that we can draw because it's so steep at the moment. There's a lot of leeway for this downtrend to move. As you can see, there's a large overhanging trend line that's going to cause a lot of resistance in the future. So that was quick, wasn't it? Great stuff though, not rocket science in any way, shape or form. Very simple. Keep it simple, guys. Do not make investing complicated. It doesn't have to be complicated. Keep it simple. Just do what works, and this is what I have found personally works for me. Guys, have a great week. Happy trading until next week. Thank you so much for stopping by. It's always a pleasure, never a chore. I will see you next week. Bye for now.